Okay, we have our global guest ready with us now. Herald Van Der Linde is head of Asia Equity Strategy at HSBC. Is joining us right now to take some questions. Herald, great to have you with us here. Thank you very much. How much should we read into the big rebound and turn that we saw just from the grips of a bear market region on Friday in the US? There was options expiry as well, but there is some chatter now that high-frequency near-term data over the next 5-10 days in the US may come in a little softer and maybe taken well by equity markets. Your sense?
Yeah, no, I was actually listening into your program over the last few minutes or so when I dialed in. And you guys were talking about the Indian situation, bond yields, inflation expectations peaking, maybe the RBI not increasing interest rates as much as what the market is pricing in, and these sort of things. And I think if you take that out and put it in a global context, a very similar kind of story is unfolding in globally. Some of the numbers that might come through might be a little bit weaker. There might be an idea that maybe some of the inflation worries are going to fade a little bit, and that we're going to worry a little bit more about growth as we go deeper into the year. That means the story of rising rates in globally, and particularly in the US, might go towards what are they going to do in 2023. They might have to cut again or something like that, but at least you're going to see a peak in bond yields. That's what we believe, and I think equity markets are responding to this, and that could be supportive to a certain extent. Not, of course, that the growth is going to slow globally, but that we see bond yields come down. That makes equities relatively more interesting. So there is a shift taking place, and we're at the very early start of this particular shift. So I was listening with interest to what you guys were saying, because I think globally we see something fairly similar unfolding.
Okay, Herald, good morning. But the big question here is that are we in some kind of a bear market, and within that these are just pullbacks which will get sold into, or is this a market which is still in a structural bull market, just going through some near-term issues? Your thoughts?
No, I think the reason why we see so much volatility is that there's structurally shift taking place. So we now live in an inflationary environment. We haven't had that for almost 2 decades or so. So that's something that we really need to learn to live with, that interest rates are going to be higher, structurally higher than what they've been in the past. And I'm talking about really short-term interest rates and the interest rates by global central banks. There could be more risk going on later in the year. Food inflation is starting to come through. So that's we have a structural shift that's taking place. In addition to that, and that's what I mentioned earlier on, there's a question how much of that is now being priced in. Could it be that some of the inflation numbers come off a little bit again? So that's a kind of a tactical story, a near-term story that's unfolding. And it's the interplay between these two that just makes, it all a little bit more uncertain, and that creates a lot of the volatility in markets. But the fact that interest rates go higher and have done so over the last 6 months or so means that equities have come lower, and that's exactly what has happened.
All right, Herald, hi, good morning. This morning the theme, the local theme at least, is the Indian government's fight to protect, against inflation with what's happening. Excise duty reduction has been announced. There's also an export duty, a 15% export duty on steel. Do you think it's enough to boost consumption, to protect the economy against inflation? And would you put fresh money to work in a market like India based on all of this?
Well, the first question, is it enough? We'll have to see. But I think it's important, and this is not only in India, food inflation is going to be an issue globally, already is in certain countries a major issue. And of course, it's in particular the people at the lower income classes that spend relatively more of their money, of their salaries on inflation, that they are going to be cut more. So governments need to step in and support these people in any way that they can do. We've seen other countries putting export bans in place on certain food commodities. Other ones are putting subsidies in place. Other ones cutting taxes again. So there's a multiple of things that they can do, and they'll have to see how this is going to play out. That's a global event to a certain extent. I think what India is doing is very much in this particular context. Does that mean you want to put money in play in India? Listen, India looks interesting. The valuations that we were worried about, say 6 months ago, they of course have come down to a certain extent. So that looks a little bit better at the moment. You still need to deal with food inflation and with rising interest rates. So the macro is not as good as maybe in other parts of the region. I also think that India is being used as a funding market for people to rotate back into North Asia. So that could overlay on India. But ultimately, India's got a couple of fantastic growth stories across the market, from food and consumer to hospitals and medicines and stuff like that. So you want to go dig a little bit deeper in these markets and look for some of the opportunities that might arise in due course in India.
This is going to be, Harold, from what I'm hearing from you is that, and the point about that something structurally one should be prepared for higher interest rates. So the equity market is in it for the long haul. It's not going to be a quick affair like what we've seen happening earlier. Sharp corrections get bought into and we go high, start going higher once again. So that's not happening anytime soon, faster. So pullbacks notwithstanding. That should be the message?
Yeah, I think that should be the message. The situation is a little bit different now. We have inflation, we've got higher interest rates, we're weaning off the QE that we've had. That has been so supportive, right? Liquidity has been so supportive. So that these pullbacks won't happen, won't snap back as quickly as they've done in the past. We need to focus a bit more on growth that will support the equity story. So you could look for markets and industries where growth is very visible over the medium to longer term. And that's where in the past you just bought anything that was growing even decently, or maybe sometimes wasn't even growing or wasn't generating any cash flow. As long as with low bond yields, all these equities were going up. So we have to play these markets very, very differently over the next couple of years than what we've done over the last couple of years.
Harold, what have you made of this consistent selling by the foreign investors in Indian market? I mean, you can blame some of it on ETFs, but it's been almost 6 or 7 months of, almost $500 million kind of selling that we are seeing. Your thoughts?
I think you mentioned something earlier on that it's been offset by domestic buying. I mean, foreign selling is equal to domestic buying. So one thing is domestics have been buying into equities, and I think that's a demographic story that is across the whole of the region, but in India play as well. People got a little bit richer, they're getting older, they're going to put their retirement, they think a little bit about that, and they're putting money aside to do that, and buying equities is a good way to do that. So that's one thing. Secondly, in India, I think India has been the market where people went to last year in order to get away from China. They were very negative on China, and India is a large liquid market that's really uncorrelated with China. So therefore, that was a good place to go. And there's some really fantastic growth stories, of course, in India as well. That is shifting now. We see now that sentiment is shifting a little bit more towards China, and I think they're using India as a funding market. So let's sell India, go back into China. That's for the near term, maybe a little bit further upside. And North Asia, Korea and Taiwan might come a little bit into play as well.
Coming back to your views, earlier you said that India is perhaps a good market that you would look for investing into. Given that we've had some measures by the government to tame inflation, do you think consumer sectors like autos are something that could benefit in the longer run, and would this be a place to buy?
No, absolutely. I think India is chock full with really interesting stories that are not really so macro sensitive. So interest rates can go up and down, but there's a lot of penetration of markets, jewelry retailers that are building out their stores, right, and optimizing that. Or if things open up, you get medical health care and travel for that comes back. So there's interesting growth stories that will probably go on, irrespective of what the macro environment. Of course, these stocks will be impacted by inflation, interest rates and stuff like that. But in the longer run, these stories still look quite interesting. And those stories that you got to be looking for in the Indian equity market. All
right, Harold, we leave it at that. Thanks a lot for joining us and giving us your views on how to approach the markets. But a quick programming note, we have a big interview lined up in just hours from now. The RBI Governor, Shaktikanta Das, will speak to